Welcome back. Before we start today's lecture, let us briefly review where we stand at the moment in terms of the course. What are the key takeaways from the discussions that we have so far? The first thing that we have analyzed and understood is that the theoretical forward price based on the principle of no arbitrage works out to S naught exponential R t. Of course, here we are using R as the continuous compounded interest rate. The second thing, forwards are private contracts and futures are exchange traded. Future contracts carry no default risk compared to forwards. Forwards may carry default risk because they are private contracts. Futures, the performance of futures is guaranteed by the clearinghouse of the exchange at which they are traded. The clearinghouse on its own protects against loss for default through the processes of marking to market and margining operating in tandem. As a consequence of marking to market, the maximum loss on a futures contract before detection is confined to 1 day's change in price. Contrast this with the loss in the case of a forward contract, where the cash flows occur at only one point in time, that is at maturity, and consequently the loss would be the cumulative loss over the entire life of the forward contract. And the incidence of default is immediately detected in the case of futures contracts, because settlement is T plus 1, where T is the trade date. That means, on the next day the obligations for the arising out of settlement of the trade date must necessarily be completed. And the possibility of that 1 day's default is also covered by suitable margining, span margin plus exposure margin, which is additional margin, a cushion against possible heavy MTM markings. Another consequence it is pertinent to mention here is that once there occurs an MTM marking to market, all the contracts that are traded with a particular underlying and with a particular maturity are rescaled to the current market price, as I had shown in the context of the figure that appears on the screen. Once the difference in the prices as on January 1 and January 2 due to change in the perception of the investors, which was 15 rupees in this example. If this 15 rupees is paid by the through the process of marking to market. So, if there is a transfer of cash of 15 rupees from party B to party A, both parties now arrive at the same threshold, and therefore, you cannot distinguish between the two contracts once marking to market has taken place. This diagram depicts how the futures and forward prices would change. Given a particular spot price, as the maturity of the future forward contracts increases, the forward price will also increase exponentially, as is given by S naught e to the power R t, this is equal to F naught. So, as keeping S naught fixed, as time increases, the forward price would also normally increase. Futures price should also increase in a similar pattern, because at the end of the day futures contracts are akin to forward contracts in terms of the net price that is paid by the long party for acquiring the asset. However, there is a broader aspect to it, in the sense that futures contracts being traded on the exchange are subject to forces of demand and supply. Demand and supply are not necessarily uniform or do not move in tandem with the forward price curve. The interaction price of demand and supply, which would be the market price of the futures contract, does not necessarily move absolutely in line with the forward price curve. Why is it so? There are so many factors. The heterogeneous risk return trade off of the various market pairs, asymmetries of information, anomalies in the market are some of the instances which contribute to futures price being a slight variance with the forward price. As you can see, they would be hovering around the forward prices, but they would not necessarily coincide with the forward prices at all points in time. However, at the same time, a divergence of the form which is shown in the figure is also extremely unlikely. Although it cannot entirely be ruled out, because again I come back to the future prices are random variables. Therefore, there would be some finite probability of this divergence, but that would be very small. They would normally move along this curve, but with slight variations up and down around this particular curve. We have discussed how futures work, how this marking to market takes place, and how in spite of the marking to market on a daily basis, the party who is long in the futures contract ends up paying the same price at which he initiated the futures contract for acquiring 1 unit of the underlying asset, which is F naught. Now, we have talked about the relationship between spot prices and forward prices, which is no arbitrage condition, the theoretical futures forward price. Before I take up hedging with futures, there is a very important arbitrage philosophy between the forward prices and the futures prices. It is very interesting, very intriguing, and therefore, I thought I must put it as part of this presentation. The process goes like this. We have a futures contract which is of maturity of capital N days. Capital N days is the maturity of a futures contract on a given underlying asset. In other words, at the end of N days, the futures will mature, and delivery, we assume that delivery is physical for the moment, but we will relax this immediately. Let us assume that D is the daily compounded interest rate calculated on a daily basis. In other words, if I have R is the annual compounded rate, then I can write R as 1 plus D to the power 365. So, D is the daily compounded rate expressed on a per day basis. Normally you would divide it by 365, but since we are taking D as per day basis, the dividing by 365 within the brackets is implicit in the D factor. We assume that this is constant over the life of the futures contract, that is between 0 and N days. The strategy that we are going to follow is, at the end of day 0, we take a position in 1 plus D contracts futures. Now, the immediate question would be, D is going to be a decimal, a fraction, and 1 plus D therefore is going to be a fraction. Therefore, how can we take a position in 1 plus D contracts or 1 plus D units? That does not invalidate this argument. You simply multiply it by a suitable number of 10 to the power whatever you choose to work out the strategy up to the desired level of accuracy. For example, if you are working with D up to 2 points of decimals, you instead of having one contract, you take a long position in 100 contracts. So, the argument still remains valid irrespective of D being a fractional value, and therefore, 1 plus D being a fractional value. That does not invalidate the argument or whatever is to follow. So, at the end of day 0, we start with 1 plus D contracts. At the end of day 1, we upscale this holding to 1 plus D whole square number of contracts. In other words, we add to our holding and we increase our holding from 1 plus D to 1 plus D square. And we continue this strategy. At the end of day 2, we make it 1 plus D whole cube. So, at the end of day n, or at the end of day n minus 1, I will have 1 plus D to the power n contracts. At the end of day n minus 1, I will have 1 plus D to the power n contracts, and that would be the opening balance for the next day, the nth day. In other words, at the beginning of nth day, beginning of nth day, I will have a long position in 1 plus d to the power n contracts. Let us assume that the settlement price at the end of day n minus 1 is f n minus 1 and the settlement price at the end of day n is f n. Therefore, the profit on day n, my holding is 1 plus t to the power n, the change in price is f n minus 1. So, the profit that will be transferred to my margin account will be 1 plus d to the power small n, that is multiplied by f n minus 1. This is the profit that I will earn on the nth day. And what will be its future value at the maturity of the contract, that is capital N? We simply multiply it by 1 plus d to the power, because there are capital N minus small n days remaining. We have already crossed up to the nth day. So, there are capital N minus small n days remaining of the life of the contract. Therefore, the future value of this profit becomes f n minus 1 into 1 plus d to the power small n. This is the profit for day n multiplied by the future value interest factor, that is 1 plus d to the power capital N minus n, because d is the daily compounded rate. So, we have the future value of the nth day's profit. The future value, no, it is important, this is an algebraic relationship. So, this can be negative as well, we are not concerned with that, it may be positive, it may be negative. So, f n minus 1 into 1 plus d to the power capital N is the future value of the profit for the nth day. Because we are holding the strategy, we are maintaining the strategy over the entire life of the futures contract. Therefore, the accumulated profit, I reiterate, it may be negative. The total value of the profit, the future value of the profit on the date of maturity of the futures contract, that is capital N, works out to be the summation of this quantity, and which is nothing but f capital N minus f 0 into 1 plus d to the power capital N, because the intermediate terms will cancel out. For example, f n minus f capital N minus f capital N minus 1, and then we have f capital N minus 1 minus f capital N minus 2. When you add these terms, the intermediate terms cancels out, and so on. So, the net result for the moment, is that we have the future value of the entire profit during the entire holding of this particular strategy, where we are every day increasing our holding, works out to f capital N minus f 0 into 1 plus d to the capital N. Now, f capital N will be nothing but the spot price on the maturity of the contract, because of convergence, because the no arbitrage principle will ensure, we will talk about it in a few minutes, because the no arbitrage principle will ensure that the spot price on the date of maturity of the futures contract and the futures price for futures delivering on that date, on the same date, must necessarily coincide, otherwise arbitrage will take place. Anyway, so f capital N is equal to S capital N because of no arbitrage requirement, and therefore, my payoff from the strategy as on the date of maturity of the futures contract works out to S capital N minus f naught into 1 plus d to the power n. To eliminate this minus f naught, what I do is I invest in a bond at t equal to 0 at the beginning of the strategy, at n equal to 0 rather, at the beginning of this implementation of the strategy, the day I started taking position in this futures contracts. At that day I invest an amount f 0, in a bond that provides the same rate of interest, which is D. Therefore, the future value of this investment will grow to this amount as on day n, capital N, which is the day of maturity of our futures. In other words, my investment, if I make an investment f0 at t at n equal to 0 and I follow this strategy, I do both the things. I follow the strategy which I have outlined above, and I make this investment in a risk free bond of an amount f naught at the rate D. The total cash that I will receive on maturity at day n will be this amount f naught into 1 plus d to the power n plus this amount, and that works out to S n into 1 plus d to the power capital N. This is the total outcome of the pair of transactions, or the pair of the set of transactions. Number 1, follow the strategy of adjusting your holdings to 1 plus d to the power n every day, and in addition to that you invest an amount f naught in a risk free bond for n days. So, this is the total cash flow that I am going to get. Now, let us look at an alternative strategy. This is as far as the futures go. This is the strategy involving futures contracts, but we have to arrive at a relationship between the futures contract price and the forward contract price. So, how do we do that? We also look at an alternative portfolio. In this alternative portfolio, what I do is, let us assume that G naught is the forward price, for a forward contract on the same underlying and the same maturity. It is not futures, it is forwards now. Now, we moved over from futures to forwards. G naught is the forward price for one contract or one unit, whatever we are taking of the underlying asset for maturity at n. I take a forward contract or along a forward contract on 1 plus d to the power n units or n contracts. In other words, on the maturity, on the date of maturity of the contract, I will get these many units of the underlying asset, and what will I have to pay? I will have to pay this into the forward price, which is G naught. This is the cash that I will have to pay, and this is what I will receive on maturity. Now, what will be the value of this in the market? Since this is the number of this is the number of units that I will receive, they will be valued at 1 unit is valued at S capital N, that is the spot price on maturity. Therefore, 1 plus d to the power n units will be valued at S n into 1 plus d to the power n units, n rupees or monetary currency, money value. This is what will be the value of the delivery that I will receive under the forward contract, and what will I have to pay? I will have to pay G naught into 1 plus d to the power n. To finance this amount of G naught into 1 plus d to the power n, to finance this amount, what do? I invest an amount G naught today, that is t equal to n equal to 0. I invest this amount today when I start this arbitrage process, and in a risk free bond at a rate d for capital N days, and what will I get on maturity? I will get precisely 1 plus d to the power n. Therefore, what do I have now? Let us recap. I have a strategy in the forward market, or by acquiring forward contracts on 1 plus d to the power n number of units, and I have a bond of the value of G naught. this value of G naught, which is a cash outflow. Now, this will be an outflow at n equal to 0. This is my investment at n equal to 0. Recall that my investment in the case of the previous strategy was F naught only. We are ignoring margins for the moment. So, my investment in the case of the future strategy was simply F naught. In this case, my investment at n equal to 0 is G naught. I invested in a bond. I receive an amount G naught into 1 plus d to the power n. I pay to the party who is short in the forward contract. I receive 1 plus d to the power n units of the underlying asset, which if I sell in the market will give me a value of S capital N into 1 plus d to the power n, which is precisely the amount that I would have received under the future strategy. Because the payoff on maturity of both the strategies, the forward strategies and the future strategy is the same. We are not considering any differential risk between the two strategies. We assume that forwards and futures are both default free, and therefore, we are using the risk free rate, which is the same in both cases. And therefore, by no arbitrage requirements, the price of the two strategies at inception must be the same, and that implies that F naught must be equal to G naught. In other words, this arbitrage phenomenon would ensure that F naught must be equal to G naught. That is, the price of a particular underlying with a particular maturity in the futures market and the forwards market should be, if not identical, very close to each other. So, this is one takeaway, but the important thing that we have, the important assumption that we have made here is that D is constant. In other words, the rate of interest remains constant over the life of the futures contract or the forward contract, which is identical of course. So, that is a very fundamental assumption, that if the interest rates do not change during this intervening period, n equal to 0 to n equal to capital N, this analysis, this no arbitrage requirement would ensure that the two prices are in close relationship with each other. But as I mentioned earlier, there could be small divergences due to certain market factors which have not been taken into account in this analysis. But the important thing is, the chances of a divergence between the two prices is very unlikely. So, now what have we got with us? We have got that forward prices vary in direct proportion to the spot prices given a given time. Given at given t, given r, the spot future forward prices move in direct relationship with the spot prices. No arbitrage also requires that futures prices and forward prices should align with each other. Therefore, futures price should also align with the spot prices. That is what this contention so far would tend to imply. Of course, there are caveats. The caveat is that futures prices, as I mentioned earlier, are determined by the forces of demand and supply, and being determined by the forces of demand and supply, they would also contain the impact of a multitude of other factors, the most important perhaps being the heterogeneity of the market participants in terms of the risk return trade offs, asymmetry of the flow of markets, that is the lack of perfect efficiency of the markets, other market anomalies that would also result in some divergences between forward and futures prices. But just to continue, the demand and supply of any asset or any even forwards and futures and other derivatives as well is determined by fundamental factors is also determined by fundamental factors, and these fundamental factors also contribute to the ascertainment of intrinsic value by various market players, and that is what in fact gives rise to market trades. The perception of assets being overpriced or underpriced based on an investor's self analysis gives results in, if an asset being underpriced, his perception being that an asset is underpriced, he would go to buy that asset and vice versa. Now, we want to start talking about hedging. Before we talk about hedging, it is necessary to understand the concept of risk, then only we can talk about hedging of risk. And before we talk about risk, we need to understand what is exposure, because risk is only relevant in terms of an exposure. If there is no exposure, there is no risk. So, let us start from scratch. Let us talk about exposure. Let us assume that there is an Indian firm, that Indian firms hold certain assets in the US, assets held by an Indian firm. An Indian firm holds certain assets in the United States. These assets may be equities, these assets may be real estate, these assets may be bonds, may be currency, may be whatever. The value of these assets, let us say at a given point in time, is VT in dollars, and it translates to VT in rupees. At this point, let a t equal to t, that is any arbitrary instant of time, any given instant of time, let there be an unanticipated, and this is important, I will come back to it, let there be an unanticipated change in the exchange rate. Now, because of this unanticipated change in exchange rate, the value of this asset will change. Let us say the value of the change in the spot rate is delta S, and the corresponding value of change in the asset is delta V. This is the change in the foreign asset in terms of rupees, of course. This is please note, this is in terms of rupees. So, delta V is the change in rupees of the value of an asset, and delta S is the unanticipated change in exchange rate which has contributed to delta V. At this point, we need to understand certain things. The immediate reaction is that delta V would be proportional to delta S, which is logical also. However, if one does a plot of delta V versus delta S for different values of delta S at different points in time, for different value of delta S at different points in time, we do not necessarily get a straight line. We do not get this straight line necessarily. And not only that, if we do a plot of the same delta S obtained at different points in time, that is, the magnitude of delta S is the same, but the observations are obtained at different points in time, we still do not get the same delta V. Therefore, the immediate inference is that delta V contains at least two factors. One factor, let us call it delta V cap, which is directly related to or directly proportional to delta S, and the other factor which is not so related to delta S, as a result of which, if you look at this diagram, when you plot delta V against delta S, you do not always get a straight line, you get points which are clustered around this straight line. So, this is where we need some understanding of the some concepts of statistics. I will come back to it after the break.